Hello friends, welcome. In this short video, I will discuss about two stocks which are value stocks and they have exponential growth in the next few years and they are also providing good dividends. So I will arrange this video in this order. I will explain first what are the growth and value stocks and dividend stocks are. Two such stocks which I have identified, an exit strategy, and I will also show you the technical charts. So in a brief, the value investing is an investment strategy that involves the picking the stocks that appear to be trading below their intrinsic value or sometimes called book value. And in comparison, growth stocks are those stocks where which can provide a high growth in their sales and also earnings. And these two are higher than the market average. Why I am discussing this? Because you have seen in the internet that people are advising others to invest in dividend, choose a dividend stocks. There are people who are giving advice to others to select a few dividend stocks, and they do not cover any information on growth and value, what the sector is, what is the potential of those stocks, what is the growth rate in those industries. So I will focus on those aspects. I will explain you that at this current juncture, it is best to choose dividend stocks which are of the value sector, as well as they have some growth opportunities. So what are the dividend stocks? So dividend stocks are those stocks which provide a part of their earning as a regular dividend to their shareholders, and the rest of the earning they invest in their business to make more revenue, more profit, etc. So these dividend stocks can provide investors a very predictable income, and sometimes also, if it is found out in a growth industry, then they will also provide some growth potential. But always remember, not all dividend stocks are good investments, and not good investments. Also, sometimes we try to buy the dividend stocks at the wrong time when market is falling. So when the market is about to fall, it is better to wait and buy those stocks at cheaper rates. And it is important to find a sector that stands to benefit from current market environment. Generally, these high dividend stocks are found in the value sectors, but as I said, not all value stocks are growth oriented, and also not always value stocks are going higher. But now there are industries like oil, like materials, where you will find stocks which provide good value, good growth potential, because of new focus on the value sectors by the US administration, as well as they can provide good growth and dividend, as I said. So couple of things one should remember while investing in the dividend stocks. The payout ratio, this tells you what percentage of the earning the stock pays to the shareholders, and a reasonable payout ratio, let's say 60% or less, is a good sign that that dividend is sustainable. If a stock provides returns all the money as the dividend, then it will have no cash in its balance sheet for future growth. Also, the history of the raises, how many times in past the company has increased its dividend year after year. And other things which are important are the steady revenue and earning growth, as well as a durable competitive advantage. So this durable competitive advantage is possibly the most important feature to look at. It can come in different forms, like a proprietary technology, a high barrier of entry, and high customer switching costs, or a powerful brand name, etc., etc. Apart from that, the dividend yield is also important. If it is a 1% dividend yield, then it may not help you, because that is even less than the bank deposit rate in some countries. So I have chosen stocks which are at least 5% or around 5% or more. So I will share you two such companies just now. One sec. So these two companies are Exxon Mobil and Energy Transfer, which I will discuss with you. So the first thing is this Exxon Mobil is the largest publicly traded company in the international, it is the largest publicly traded energy company. It is the largest publicly traded international energy company. Its principal business is energy, involving exploration and also production of natural gas, oil, manufacturing and selling different petroleum products, transportation, etc., etc. And it is available at $59 at the moment, and this is 65.35 is the analyst price target, which is the consensus price target. Actually, some of the analysts are expecting it will go to 80 plus. So it is remember its price. This Exxon Mobil's price will be dependent on the oil price, as oil is expected to go up around 70 or 75 in the next few months. So this stock should also go up. I will pass you through quickly to what the different analysts are recommending. You can see that this is a strong buy candidate. Almost six analysts have given the buy recommendations. 10 is asking to hold, and I will come on this chart later. This is the basic fundamentals of the stock, and this current dividend yield is 5.8%, and the market cap is 254 million. This is the market capitalization, 254,111,166, and this stock is the quick ratio. You can see the total debt slash data. You can see the debt to equity ratio is 0.28. So this company is cash rich. It is not depending on its debt to do day-to-day business. The other stock is the Energy Transfer. It is available at the moment is 9.80 range, and analyst target is around 30% above. I will show you both the stocks, how the stocks looks like in technically. This is also where the analysts are recommending strongly. 8 analysts are recommending it to buy, and you can see here the current dividend yield, it is showing 6.39%, and book value is 12.67. So this stock is available under its book value at the moment, 11.8, which is less than 12.67. So it means if you liquidate the company at the current the company, then you will get this price, which is higher than its current stock price. And in terms of PE, it is very cheap. It is less than 6. You can see here. And what is the exit strategy? The exit strategy is sell 50% when the price will rise to 30 to 40%. So if you invest 100, and if it goes to 140, that your initial investment, then sell half and you get $70, and you will also get this 6 to 7.5% dividend. So after 12 months, you will get 70 plus 7% dividend, so around 77. So you have left only 23rd of your initial investment on the table. So only this $23 will be at risk. And the way stock market is rising in last 10 years, it makes sense to sell 50% of the stock and wait for the new opportunities. Before we go to the technical chart, I will show you quickly 2 important themes. I'll show you Energy Select Sector SPDR Fund's return. XLE is this ETF, And you can see that almost from 2013, you can see that from 2013 annualized return. So the if it in like for example on 2013 it has given 26% return, but in the next 2 years the same return has been gone. Similarly, into 2016 it gave 28% return, and then in the last 2 years it didn't give any return. So in 2020 it gave 32.5% negative return, and in 2021 it has almost come to that level. So what it means is in last 10 years or 8 to 10 years, this XLE has not given any substantial return in terms in comparison with other industries. So this oil industry can be benefited hugely at the moment, because there is an rotation going on from growth to value across the world. And the second thing I want to draw your attention is Marco Kalanovic, who is the derivatives strategy head of JP Morgan, his views. But he said that a new commodity super cycle has been started, and there could be big gains ahead for this energy sector as a whole, not only for these two stocks, but for other stocks as well. As also the overall investment from the equity portfolio perspective has fallen from 10% in 2010 to 2015 to 3.1%, which means the money has flown out from oil to other sectors. So now, as other sectors, technology, communication, like those stocks are falling, so that money will chase the oil now. So apart from that, the inflation is moving higher in the US, and we all know that oil is the first hedge of the inflation. So if inflation goes higher, then oil must go higher. If oil goes higher, then these two companies will be benefited very much. I will now show you the technical chart of these two stocks. You can see ZOM, it is a daily chart of ZOM, and this is the 50 days moving average. This moving average, this stock is falling from here because of current fall in the stock market. It should get support in this range, and then it should go up again. If you see its long-term charts, you will find that this is the level from where the big fall started in 2020 January. So from here it fell, and now it is trying to reach that level. So this is the initial target, 67, 68 area. If it can break this level, then the next level can be viewed from the weekly chart. The next level will be in this range, 80 range. I will go to the ET chart. You can see that 50 days moving average crossed upwards, keeping 200 days moving average behind. So this is called the golden cross in technical analysis parlance. So from here, it has taken strong support in this range in 50 days moving average. Now it is going up. It might fall in this range intermittently in this 930 area, and that would be the level where you should try to buy it. This is the gap up. This gap will try to be filled. So if you can buy it here, your target will be, from the technical standpoint, your target will be around this level. This is the 200-day moving average of the weekly chart. So 1280 range, it should reach 1280 range. Thank you, guys.